Hello everybody, welcome to another lesson in financial accounting. Today we're going to look at journal entries and double entry. Okay, so we're going to look at some transactions here and we'll go through the rules of generalizing, okay, generalizing techniques. All right, the first one here, okay, the first rule is you analyze the transaction. All right, number two is you're going to identify the two accounts involved. Okay, and number three, you're going to categorize these two accounts. All right, are they drawings, dividends, expenses, assets, all right, liabilities, equity or capital, or revenue? One of these six accounts, you have to categorize these two accounts involved. You have to categorize them as one of these six accounts here with this acronym DIL, right? D is dividends or drawings, the money we move from the bank. Expenses, it's self-explanatory. It's expenses in business account. Assets are things we own. Liability are things we owe. Equity or capital is basically what the business owes the owner or the owners, right? You can also think of equity capital as what the resources put into the business by the owner, right? Usually these resources are cash, all right? So two ways you can look at capital. Then revenue, this is the money we make from conducting our business. Okay, so we have three. I'll go through three journal entries here. All right, we'll do the journal entries. I'll go through three transactions here. We'll do the journal entries and then the double entry. Okay, so January 1st, John starts a business and puts in 10,000 cash. All right, so we analyze the transaction. Here he's starting a business, all right, putting in money into his business, right? Then we're going to identify the two accounts. Okay, we're going to identify the two accounts. The two accounts involved are cash and capital. All right. Now we'll categorize these accounts. All right. Cash is an asset. All right. And capital is capital. All right. Capital, remember what I said? It's what the business owes the owner, or you can take it as the resources put into a business by the owner. Okay, so I've identified them. Now I've got to put the step 4. You're going to identify which account is increasing and decreasing. Okay, which account is increasing and decreasing. Okay, so in this case, the cash account is increasing, and we follow this rule. An increase in assets, you debit. Capital is also increasing. An increase in capital, you credit. All right, so that's the journal entry. You debit cash, all right, and you credit capital. All right, the journal entry always needs a narration. All right, being the starting of the business by John. Okay. All right, so now after we journalize, we're going to post it to our ledger accounts, also called our T accounts. This is where the double entry comes in, right? We debit the cash account, 10,000. As you can see here, we debited cash 10,000, and we'll credit capital 10,000, all right? We'll credit capital 10,000, okay? All right, January 2nd, bought equipment for the business worth 2,000, all right? Let's analyze the transaction. We're buying equipment for the business, all right? What are the two accounts involved? The cash account and the equipment account, all right? Cash and equipment account, right? Let's categorize, all right? The cash account is an asset. Equipment account is also an asset. Remember, assets, things we on. All right. Then let's identify which one's increasing and decreasing. So our equipment account is increasing, so we debit. All right, we debit our equipment account 2000. We are paying money, so cash is reducing, so we credit. We have a reduction in our asset, which is cash. We credit cash 2000. All right. January 3rd. Oh, then the double entry. All right. We debit equipment 2000 and we credit cash 2000. All right. January 3rd. All right. Purchase goods for sale worth 1500. All right. What's happening here? We are buying inventory. All right. We're buying goods for resale. Okay. So you must know the difference between purchases and inventory, right? Purchases is the cost of getting inventory, okay? Inventory are things that you already own. Purchases are what you are buying now, all right? So purchases is an expense. The purchases account is an expense account, all right? And remember, expenses are always debited, all right? Here, expense accounts always debited. Expenses reduce capital, a reduction in capital is debited, all right? So always debit your expenses. So we debit the purchases account 1500, right? Then the cash account, so we are paying for these goods, all right? We have a decrease in our asset. Decrease in our asset is credited, right? So we debit the purchases account 1500 and we credit the cash account 1500, right? So those are the examples I just wanted to show you. Okay. See you next time.